mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385. So 3,385 on the S&P 500. Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now, think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a long-term bear market? So my thinking is that the bond market would have pushed rates up. In fact, even before the Fed started raising rates, the bond market had pushed rates up. But I don't think that the bond market would have gone to this extent. I think the bond market, which is a smart market, it's known as the biggest market, it's the smartest market. They see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. And you're not giving time for it to cycle into the economy. So for all we know, in 3 months to 6 months, when all of these hit the economy, we could find ourselves in a nasty recession. And again, that's what I think the market's getting skittish about. You can see the dollar is skyrocketing again today. That's putting pressure on risk assets across the board. And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous.
Okay.
Yeah, so I do think that the labor market will start to weaken, right? I mean, it's just the nature of it. Almost every single day, and I pay attention to the stock market and the news. Yeah. There's always there's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, double what they were getting, $25 an hour or so in salary. Now, you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think even the Fed in the statement, they said they don't expect inflation to come down to 2% until 2025. No, I do think high wages are here to stay. I mean, with the inflation numbers, I mean, like, keep in mind, everyone has to keep in mind is that even if we went to a zero inflation number like tomorrow, you know, a price of an apple is still up 50% from where it is. And so you can't just see wages all of a sudden go back to where they were. So I do think where we are in wages is what people get used to. People do not take well to wage cuts. And so I think you're going to see wages stick at these levels for the longer term. Now, they're not going to rise really, but at the same time, they're going to stick here. And again, that's going to be something that these businesses will have to pass through over time. That's exactly what it is. And I think it's going to be a lot further out than 2025. And I think it's going to be a very scary situation when again, we do see the Fed continue to raise and push us into a recession, and then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. It had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside. Yeah, so to me, it makes perfect sense. I mean, think about 2021 when money was free and the government was sending out checks to Americans nonstop. And so there was just so much liquidity and money in the system that a ton of it wound up in the stock market, buying tech stocks, these tech stocks that had no earnings, that were trading at crazy multiples to revenue numbers. And now you're seeing this kind of suction. It's almost like a vacuum sucking the liquidity and the money out of the system through higher interest rates, through quantitative tightening, QT, and that's going to just bring down these asset prices. And we've seen, I mean, amazingly, like a stock like Roku down from what, 500 to like $60, kind of, I mean, incredible type drops in these assets, but it makes a lot of sense since the money is getting sucked out. There's not as much money to go around to so many stocks now. Oh, I mean, you know, it's definitely going to happen. So the 3370, 3380 level I have for the S&P is based on kind of the quantitative tightening, the Fed raising interest rates, and the market just panicking. What's going to happen is you're going to have this pivot come with the Federal Reserve where the economy starts to significantly weaken. They step to the sidelines and they stop raising rates, and the markets are going to cheer, and you're going to see a massive bounce probably off that February 2020 level of 3370 to 80. The problem that's going to be, and the next leg down that takes us to 3,000 or sub 3,000 is a few months later, we're going to realize how bad the recession is. And then we're going to turn to that Federal Reserve and say, Jerome Powell, come save the day. And the Fed is going to say, can't do anything, guys. We have inflation that's too high. And that realization, I mean, think about the addiction of the markets over the last 20 years to this. The Fed always bails us out. I mean, in 2018, the Fed just threatened to basically raise rates. The S&P and the NASDAQ dropped 20%, and the Fed quickly reversed and started printing money again.